In this video, we're going to talk about how to maximize the return on money you've set aside to pay taxes. Hey, I'm Shyam Ganesh with Grow Your Wealth Financial Planning. A question I often get asked by business owners is, what can I do with the money that I've set aside for paying taxes or making other short-term payment obligations that are coming up? And so what I often see business owners doing are, first of all, if you are setting aside cash in a separate account in order to pay taxes, congratulations, you've got a huge head start. And if you're not doing that already, then I would highly suggest that you begin to set aside a certain percentage of your revenue 1 to 2 times a month in a separate bank account at a separate institution. Now, the next question that I get from a lot of business owners is, okay, I've set up this money, set aside this money. How do I actually invest that? I want to get some sort of return on it while I'm waiting to pay it to the government. And obviously, a 0% on a checking account in a big bank is unacceptable. And so, what is there that you can do that's more than that? Well, the first thing I'll say about taxes is that it really is not your money. It is the government's money, whether that's a GST, HST, PST, a corporate tax bill, a personal tax bill. These are all money that will be owed to the government in a very short, relatively short. When we say in as a financial planner in investments, what we say is, 1 year is still a very short time horizon. And what you don't want to do in that 1 year is lose money, and it's very easy to do that when you invest for the short term. And so what you don't want is the money going into a stock market based investment where you've got all of these stocks and you could have way less money when it comes time to pay the bill than when you started with what you had saved. So capital preservation is absolutely one of your top goals for money you set aside for taxes. The other thing you also don't want to do is put that money into something like real estate where it's really not liquid. Like, you can't buy a property and turn around and sell it 1 or 2 or 3 or 6 months later without taking, most often without taking a loss on it, and it's not guaranteed that you can sell it. So it's simply not liquid, and what you want is to have access to that cash when the time comes. And with an investment like real estate, it also usually needs a longer time frame in order to make money. And so similar to stocks, real estate would be where not to put aside money that you've set aside for taxes. So what does that really, leave you with? There's lots of other kind of growth-oriented investments that are out there, but really what I'm saying is it should be in something that is very low risk. Now, 0% is unacceptable, but you can earn a little bit of a return even without taking any risk. And so these are all investments that would be considered cash equivalent. So instead of a checking account, you could go into a high interest savings account. Or you could go, if you have a certain timeline, so that you're not going to need that money for 3 months or 6 months or 9 months or a year, then you can lock it into what's called a GIC, a guaranteed investment certificate. And that will give you a slightly higher interest rate in exchange for that loss of liquidity. So you may or may not be able to redeem it. There's different types of GICs over the course of the 3 or 6 month or 9 month period. and in exchange for that lack of liquidity, you do get a little bit more of an interest rate. There are also ETFs, exchange traded funds, that are high interest only. Okay, so ETFs are generally designated as equity instruments where there's more risk. There are certain funds, exchange traded funds, that are high interest only, and they can be a bit more of an interest rate than your savings account at the bank, but they are not guaranteed. So where the savings accounts and the GICs are absolutely guaranteed, once you put money into an ETF, it is not necessarily guaranteed. Now the risk of loss there is relatively low, but it's a key difference. So those are your options. If you're in doubt, always just stick with a high interest savings account. You can't go wrong with that one. If you've got a lot of money on the sidelines, and you're it's itching to you that you can't make more of a return on it, and you want to talk about this, just feel free to fill out my questionnaire below. It takes 2 minutes, and it is something, these types of questions can be quite nagging, and you're never really sure if you're doing it quite the most optimal way. And if you want to chat about this and other things, just fill out the questionnaire below, and that'll qualify you to meet with me for 30 minutes, where we can get to know each other, and you can ask me any questions you want, and I'll be happy to support. So thank you so much for joining me on this video, and I look forward to seeing you on the next one.